Now, Bloomberg's Ty Marega joins us now with his guest, Peter Churchouse, a managing director at Morgan Stanley Dean Witter, to discuss the outlook for Hong Kong's property sector. Good morning, Ty.
Good morning, Kathy. Yes, it's been a pretty rough ride for Hong Kong's property market over the last couple of years, and it looks like this year is no different. However, has the Hong Kong government come to the rescue with stimulus measures announced by Chief Executive Chee-Hwa? Well, Peter Churchouse is here to answer that question and a few others. Thanks very much for joining us, Peter.
Good to see you, Ty.
Firstly, how greatly do you think those measures are likely to lift the market or consumer confidence in Hong Kong?
I think very little, quite frankly. The measures are very small, very tiny, but I think it is a gesture, and it will be seen as such by the consuming public here in Hong Kong. So really, in physical terms, no. Liquidity is terrific anyway in the market. Affordability is great. So these measures, I think, are really more of a gesture rather than actually having a great physical impact on the market.
Okay, what about investor confidence? Is it likely to pick up anytime soon, do you think?
I think as far as investors in real estate are concerned, I think sentiment will continue to be relatively weak over the course of the next few months here. I think people are adjusting to the sense that the economy is going to be worse than we were otherwise thinking a couple of months ago. It's going to perhaps be sharper on the downside, and I think that's going to dampen consumer sentiment. It already was very fragile, and I think it's perhaps going to remain fairly fragile over the course of the next 2 or 3 months.
Peter, Kathy Yang here from Tokyo. Just wanted to get your views on the residential property sector. How different is that from the commercial side right now?
Well, the residential side has actually suffered pretty badly since the '98 financial crisis in Asia. Prices are down 50 to 60%. We've seen no turnaround on the upside really at all, despite very, very good liquidity and interest rate conditions. On the commercial side, however, we have seen a huge pickup last year. Office rents, for example, picked up about 48% on average last year. Prices have come up off the bottom as well, but it's been a little weaker this year in terms of commercial property. Demand has slowed down a little. So I think the commercial side has recovered rather more than the residential side at this stage of the cycle.
Now, the Hong Kong government will auction off some more land next week. What are you expecting of that?
To be honest, I think we will see reasonable demand for these sites because I think many of the developers are now thinking we're pretty close to the bottom of this cycle, and now's the time you should be picking up additional land for your land banks. Having said that, though, I think investors and developers are very cautious about the prospects over the next year or two. They're not expecting to see 30–40% upside in prices. So I think what you'll find is that, yes, these sites will get sold, but they're not going to get sold at huge prices. I think we'll still see an attitude of caution prevailing over the course of this next month or two.
Okay, now we've seen a lot of revisions recently of economic forecasts and downgrades of stocks. How do you think that's likely to impact on the commercial sector?
On the commercial sector, I think the important thing here is Hong Kong has experienced an extremely tight supply condition. We've just got no supply of office space over the next few years. We're forecasting, in our latest forecasts, with even revised downwards economic GDP forecasts, we're expecting to see the vacancy rate in commercial property range somewhere between 5 and 7% over the next 4 years. That's the longest period we've seen in a very, very long time of vacancy levels so tight. Under that scenario, it's very hard to envisage that office rents and so on are going to collapse under that sort of tight supply scenario. So I'm expecting to see that rents will actually pick up again after this year's sort of very weak sentiment. I think you're going to see office rents pick up quite sharply next year. So I'm very bullish on the commercial prospects of the next 2 or 3 years.
Okay, if we take a look at the Bloomberg screen here, we can see how one of Hong Kong's larger players, Sun Hung Kai, reacted quite well recently. It seems since Monday, since this week, since the announcements were made by the Hong Kong government about economic stimulus measures. Do you think that's having an effect at all, or are there other factors behind Sun Hung Kai's
Quite frankly, I think it's other factors. Sure, I think there may be a little bit of impact there from the government's measures announced the other day. However, the whole market has rallied quite nicely over the last few days in the trading sessions we've seen. So I think it's perhaps more in sympathy with the general market. This is one of the biggest and most liquid stocks. It is regarded as an extremely well-managed company, and it was clearly oversold over the last couple of weeks. It was trading at about a 40% discount to its net asset value. So I think it was clearly oversold. Very good time for a rebound here.
Okay, New World Development seems to be battling a little harder than most these days. What are your views on that?
Well, I think analysts have really had New World Development completely wrong. Forecasts for this year's earnings were way, way, way too high. We dropped our numbers to about a third of the consensus estimates. Over the last few weeks, analysts have slowly come to grips with the fact that numbers were going to be way below expectations and have begun to revise numbers down. The numbers came in way below expectations, as we kind of expected. And now looking forward, analysts, I think, are still too high in their figures for next year, and I think we're going to see more adjustments on the downside. However, this stock is extremely cheap. It's about as cheap as it's ever been in the last 20 years or so. It's trading at about a 70-75% discount to its net asset value, but earnings are very weak. So although you've got value, you've also got a lack of earnings. At this point, we would think the stock is going to be a good trading stock. This will be a stock that the traders will play quite nicely over the course of the next month or two. In fact, over the last couple of weeks, you've made very good money if you were a trader in the stock.
Okay, rightio. Thank you very much, Peter Churchouse.